Hey, this is Chris. Now in this video, I'm going to be talking a little bit about what's happening in China and Chinese tech shares at the moment. If you've been watching the financial news, what you may have seen is there's been a bit of a sell-off in Chinese shares. And in this video, I'm going to be talking about why there's been a sell-off and what's happened, how it's impacted the emerging markets ETF and the Stockspot Portfolios, and whether you should still be investing in emerging markets going forward. So first of all, what's happened recently is that the Chinese government has cracked down on a large number of sectors within the economy, particularly technology, and put together a plan of increasing regulation within these industries and also find some of the big technology players. Now, this has really frightened a lot of investors into Chinese shares, those listed in mainland China as well as Hong Kong and the US share market. We've seen a significant sell-off, particularly in the Chinese tech sector over the last few months. Now, what does this mean for the emerging markets ETF? Well, the EM ETF contains somewhere between 35 to 38% Chinese shares, depending on whether you're invested in the one that we recommend to clients, IEM, or the Vanguard equivalent, VGE. IEM contains about 35% Chinese shares, and so that 35% has been dragging down IEM recently, but then you've got other countries that have been doing quite well, like India and Taiwan, and as well as the Aussie dollar falling, these are all counterbalanced and meant that the emerging markets ETF has actually just traveled sideways over the last few months and hasn't seen a huge impact from this sell-off. Now, more broadly, if you have a look within the Stockspot Portfolios, emerging markets are around about 20%, give or take, of the portfolio. And so Chinese shares within the portfolio are only around 7%, and technology shares within that Chinese share component are even smaller. So the overall impact on the Stockspot Portfolios has been pretty negligible. And in fact, compared to China's contribution to the global GDP, which is around 17 or 18%, our 7% allocation in emerging markets is actually relatively small, even though a lot of others allocate even less to emerging markets. Which gets to my last point, which is, should you still own emerging markets in your portfolio? And my answer to that question is a resounding yes. Emerging markets, although they haven't performed well over the last 10 years, and in fact they've performed quite poorly compared to developed market shares and particularly US shares, they provide great diversification because these shares tend to perform better in environments where US shares might not be performing as well. For instance, when there's higher inflation or there's a weak US dollar, these are environments that EM shares historically have done better in. Now, we're not in that environment right now, and so what we're seeing is US tech shares really drive the global markets higher, and there isn't a lot of interest in emerging market shares, but my advice would be to keep them in your portfolio, although they're not popular now. The last thing you should be doing with any investment is to be selling when there's bad news, because bad news is already embodied in the price. And as we saw in March 2020, selling when the news is worse is the worst thing you can do because everyone else has already sold, and that's actually the best time to be buying. So keep emerging markets in your portfolio. They might not be the shiniest object right now, but there will be a time in the cycle where they're driving the performance, and that's why you need them in there all the time.